Political ad spending in 2026 is projected to shatter every record ever set, including presidential election years. We're talking about an estimated $12 billion or more flooding into media markets across the country. And most investors have absolutely no idea what that means for their portfolios. But here's the thing. This isn't just a political story. It's a money story. And if you position yourself correctly before the wave hits, you could ride one of the most predictable spending surges in modern economic history. In this video, you'll discover exactly why 2026 election ad spending is set to outpace even presidential cycles, which sectors and ETFs stand to benefit the most, how the Federal Reserve's interest rate environment shapes the way this money moves through the economy, and what specific actions you can take right now to align your portfolio with one of the largest advertising booms in U.S. history. Stay with us, because the window to act is shorter than most people think. Let's start with the numbers. According to projections from Ad Impact and the Cross-Screen Media Research Group, total political advertising spend for the 2026 midterm election cycle is expected to exceed $12 billion, a figure that would surpass the $9.7 billion spent during the 2022 midterms and rival, if not outright beat, the $10.2 billion recorded in the 2020 presidential election year. Why is a midterm year suddenly outpacing a presidential cycle? The answer comes down to three compounding forces: redistricting battles still playing out from the 2020 census, an unusually high number of competitive Senate seats up for grabs, and the rapid migration of political dollars toward connected TV and digital streaming platforms, environments where cost per impression continues to rise. Record money chasing scarcer inventory means prices go up. That is the core dynamic every investor needs to understand. Now let's talk about where this money actually lands. The biggest direct beneficiaries are broadcasting and media companies, local television station operators in swing states, streaming platforms with ad-supported tiers, and digital advertising networks. Companies with heavy exposure to local broadcast TV have historically seen their stock prices outperform the broader S&P 500 in midterm election years by a meaningful margin. Beyond pure media plays, programmatic advertising technology firms and data analytics companies that serve political campaigns are seeing surging demand. This isn't speculation. It's a repeating pattern backed by decades of election cycle data. Smart money follows the calendar. So how do you get exposure without picking individual stocks? This is where ETFs become your best friend. Broad communication services ETFs, such as those tracking the communication services select sector of the S&P 500, give you diversified exposure to both the large-cap digital platforms and the legacy broadcast infrastructure that captures political dollars every cycle. Additionally, small-cap media ETFs can offer more targeted exposure to local broadcast operators, though with higher volatility and risk. Always understand what's inside the fund before you buy. Not every communication ETF is built the same way, and some carry more streaming and telecom weight than pure advertising exposure. Read the prospectus. Know your holdings. Here's a layer of this story that almost nobody is talking about. The Federal Reserve's interest rate environment matters enormously for how this ad spending boom translates into stock market performance. When interest rates are elevated, as they have been coming out of the aggressive hiking cycle that began in 2022, the cost of capital for media companies rises alongside rates. That compresses margins even as revenue grows. However, if the Federal Reserve begins cutting rates ahead of or during the 2026 cycle, as many economists currently project, that becomes a powerful double tailwind: more political ad revenue coming in and lower borrowing costs improving profitability at the same time. Watch the Fed. Watch the rate curve. The two stories are deeply connected. There's also a broader economic signal embedded in this ad spending surge that affects the S&P 500 as a whole. Large influxes of political advertising dollars act as a short-term stimulus injection into regional media markets. Local economies in battleground states, think Pennsylvania, Georgia, Arizona, Wisconsin, absorb billions of dollars in a compressed 6 to 9 month window. That spending ripples outward. It supports local jobs, boosts regional consumer sentiment, and historically correlates with above-average GDP growth readings in the quarters where election spending peaks. For investors in broad index funds tracking the S&P 500, this is a subtle but real tailwind baked into the macro environment of 2026. Don't overlook the forest while you're studying individual trees. Before you make any moves, let's be clear-eyed about the risks. Media sector investing is not without volatility. Cord cutting continues to erode traditional broadcast audiences, and political ad dollars, while large, are temporary. They do not build recurring revenue. A company that spikes on election spending can fall sharply once the cycle ends. If you are investing in sector ETFs or individual names tied to this theme, you need a defined exit strategy. Set your time frame before you enter the position. Know whether you are playing a 6-month catalyst or a multi-year structural shift. because those are two very different investment theses requiring very different approaches. Discipline protects capital. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before investing. Now here is your action checklist. First, research communication services ETFs that have meaningful exposure to advertising revenue. Look at the top holdings and sector weighting. Second, monitor Federal Reserve statements and the interest rate outlook for 2026, because rate cuts would amplify the upside for this theme considerably. Third, set calendar reminders for Q3 and Q4 of 2026, when political ad spending historically reaches its peak velocity. That is when the numbers hit the income statements. Fourth, revisit your portfolio allocation now, while valuations in this sector are not yet pricing in the full 2026 tailwind. The time to plant the seed is before the harvest season arrives. The 2026 election advertising boom is one of the most data-supported, calendar-driven investment themes available to everyday investors right now. The money is coming. The only question is whether your portfolio is positioned to benefit from it, or simply watching from the sideline. Do your research, manage your risk, and make informed decisions. That's what separates investors who build wealth from those who only read about it later.